Gold was down 3%. The gold stocks, the GDX, was down 6.5% on the week, and the GDXJ was down 7%. Why? Right? It makes no sense. Yes, I know gold went down, but so what? It went down to 3,300. That is a very high price for gold relative to all of the earnings expectations for these gold stocks. Nobody that covers gold last year expected gold to be at 3,300. In fact, when gold got to 2,000 a little over a year ago, nobody thought it can go any higher. They all thought that was the top. And here we are more than 50% higher. And stocks like Newmont and Barrick are lower than they were back then when gold was at 2,000. Now, there are some stocks that are higher, but the two biggest stocks are actually lower. So why should they even go down at all? They should just be going up every day, regardless of where gold is. Who cares? I mean, if gold's bopping around above 3,000, that is a phenomenal price. In fact, we got the Newmont earnings. They were the first major gold company to come out with earnings. We got those earnings after the market closed on Thursday, I believe. And so Newmont beat its earnings estimate by 42% above what analysts thought they were going to earn. That is a massive beat. Their year-over-year revenue in the quarter was higher than the prior year's revenue by 25%. That is a huge increase in revenue in a year. But their profit, quarter over quarter, were up 127%. I mean, how many companies in the S&P 500, Newmont's the only gold company there, are going to report year-over-year profits up 127%, a crazy amount. You would think, oh, this stock's going to be way up because, gold was up like $50 that day too. It was a day that gold happened to be up. So gold's up $50, the earnings come out, and the stock's up like 2% that after hours. If the price of gold went to 10,000 tomorrow, right, and then it went down to 9,000, right? Would these stocks really have to get killed, especially if they barely moved up on the move to 10,000, right? I mean, once you have this kind of breakout, which is what we've had in gold. See, what people don't really get is that for years and years and years, gold has been underpriced and underowned, right? Investors don't own it. Central banks have a very small amount. If you look historically, even though they've been buying a lot of gold, if you look at the gold that central banks own as a percentage of their total reserves, it's still historically low. It's not as low as it was, but it's still below historical average. That's because the currency reserves, mainly US dollars, have exploded. And so central banks have underowned gold. Retail investors have completely underowned it, and institutional investors. So the private sector has underinvested in gold, and so has central bank. And so gold prices have been too low. Meanwhile, the cost of mining gold keeps going up because of inflation. Now, if gold was purchased the way it should have been by investors and central banks, given how much inflation was being created and all the dollars and our trade deficits, the price of gold should have been a lot higher, but it wasn't. And the biggest victims of that were the gold mining stock because they had to deal with the inflationary impact on costs without getting the full impact on the price of gold. Well, that's now changed. Ever since, I think, early 2024, gold prices are now far outstripping the cost of mining. But Wall Street hasn't figured that out yet. They haven't re-rated these stocks. So at some point, they need to be massively re-rated at much, much higher prices, even if gold goes down hundreds of dollars, because it's already moved up so much beyond the cost of mining it. Plus, this breakout means that gold is going up. 34.90 that we got on Monday, that is not the record high for gold for all of eternity, not even probably for the rest of the month. Gold prices are going above 3,500. They're going to go above 4,000. They're going to go above 5,000. So what should these gold stocks be worth? Because the cost of mining is not going to go up anywhere near the same percentage. It will go up. Inflation is going to drive the cost of everything up. But as investors realize how bad inflation is going to be and how long it's going to be here, they're going to keep bidding up the price of gold.
Gold was down 3% this week, okay? Not 30%, not even 5%, just 3%. Meanwhile, GDX, the index of gold miners, was down 6.5%, and GDXJ, the junior miners, down 7%. Why? I'll tell you why. Because Wall Street still has no idea how to value gold stocks. None. They treat them like meme stocks, like they don't actually produce anything. But these companies aren't memes. They're printing money. They are raking in profits, growing earnings, and generating more free cash flow than at any point in the past decade. And they're doing it with gold sitting above $3,300 an ounce. That is an insanely profitable environment to be mining in. Let me remind you what happened with Newmont, one of the largest gold mining companies in the world, and the only gold stock in the S&P 500. They reported earnings Thursday after the market closed. You know what those earnings showed? They beat estimates by 42%. 42%. That's not a small beat. That's a beatdown. That's a monster beat. Revenues were up 25% year over year, and profits up 127% quarter over quarter. That's right. Let me say it again. 127% increase in profits. You show me another S&P 500 company that did that this quarter. You can't. But guess what? The stock barely budged. It was up, 2% after hours? That's it? Gold was up $50 that day too. You'd think the stars had aligned. Nope. The stock barely moved. This is madness. Now think back a year ago. Gold was at $2,000. Everyone said, oh, that's the top. That's it. It can't go higher. Well, we're now over 50% higher. And what happened to Newmont and Barrick, two of the biggest miners in the world? They're both trading lower than they were when gold was $2,000. Not just not higher, lower. Let me ask you this. If gold went to $10,000 tomorrow and then dropped back to $9,000, do you really think these stocks should get slaughtered? Even if they barely moved on the way to 10,000? At some point, you've got to ask, what does the market actually believe these companies do? Wall Street still doesn't understand that this breakout in gold is real, that it's secular, structural, permanent. They're still trapped in the mindset that gold is a trade, that it's a hedge, that it's something you sell when inflation goes down or when the Fed raises rates. They have no clue what's coming. What's coming is the realization that gold has been underpriced and underowned for decades, that investors have been asleep at the wheel while central banks have been quietly rebalancing their reserves away from US dollars and into gold. Let's talk about that for a second. Even after a year of record central bank gold purchases, gold still makes up a tiny percentage of global reserves. Why? Because reserves, especially dollar reserves, have exploded in size, but gold holdings haven't kept pace. So when people say central banks are buying a lot of gold, they're right. But in the bigger picture, they're still underweight. And don't even get me started on retail and institutional investors. You want to know who owns gold right now? Almost nobody. Gold is still considered a fringe asset by most portfolio managers. If it's owned at all, it's usually in an ETF, in a token 2% allocation, just enough to tick a box on some compliance form. Meanwhile, the US is running trillion-dollar deficits in peacetime. The Fed's balance sheet is bloated beyond recognition. Inflation is nowhere near under control. And the dollar's purchasing power is eroding faster than at any point in the last 40 years. You'd think gold would be the #1 asset on every investor's list. But no. They're still chasing tech stocks with price-to-earnings ratios in the triple digits. And here's the worst part. The mining stocks are the biggest victims of this delusion. They've been operating for years in an environment where inflation has driven up their costs. Diesel, labor, equipment, energy. But the price of gold didn't keep pace, so they've been squeezed, margins were tight, projects were shelved, exploration budgets got slashed. But all of that has changed now. Gold has exploded higher, mining costs haven't. Suddenly, the margins are enormous. But Wall Street hasn't updated its models. They're still valuing these companies based on $1,800 or $2,000 gold, not $3,300, not the $3,490 we saw on Monday, and certainly not the $4,000 or $5,000 we're going to see in the next couple of years. And we will. Because here's the truth. Gold is not just going up because of inflation. It's going up because confidence is breaking. Confidence in the dollar, in the federal, in the entire post-Bretton Woods fiat system. People are waking up. And when they do, they're going to realize that gold mining stocks, real companies that pull real money out of the ground, are the best leverage to rising gold prices in the entire market. At some point, Wall Street is going to have to re-rate these stocks. And I don't mean 10% or 20% higher. I mean multiples. These stocks are going to go 3x, 5x, maybe even 10x from here. And that's not even factoring in higher gold prices. That's just fair valuation on today's numbers. Let me give you an analogy. Imagine you're buying a company that mines $3,300 worth of gold for $1,100 a pop. That's over $2,000 in profit per ounce. You'd expect to pay a premium for that kind of margin, right? But no. These companies are trading at 5, 6, maybe 7 times earnings. That's insane. That's like buying Apple in 2003 or Google in 2005. Except instead of selling phones or ads, they're selling money itself. And the icing on the cake? The industry is consolidating. Junior miners are getting gobbled up. The majors are cleaning up their balance sheets. Dividends are rising. Costs are stable. The supply pipeline is thinning. We haven't had major discoveries in years. That's bullish. This is the setup of a lifetime.
I think what happened, especially looking at what was happening on Monday night, because all of those trends continued on Monday night. In fact, gold hit a new all-time record high. It was within $10 of 3,500. That's how much gold had gone up. It was above 3,490. Now, you may expect some profit taking at a round number like that. We were almost halfway between 3,000 and 4,000, and we had only just breached 3,000 like weeks ago, and now we're almost halfway to 4,000. But the dollar was getting killed. The euro was above 115. There was a 97 handle on the dollar index. Stock futures were selling off. Bonds were under pressure. They didn't make new lows, but they were on their way. And so I think looking at what was happening in the markets, the advisors to Donald Trump got to him and said, we need to do some damage control. You need to walk back that Truth Social post. And so on Tuesday morning, early in the morning, Donald Trump said, hey, of course I'm not going to fire Trump, Powell. He's going to be there until the end of his term, or I'm not going to do anything with Powell. And the market had a huge rally on that. And, it's hard for me to believe with all of the market savvy people that are in the Trump administration. A lot of people have come, from Wall Street, right, that are there. And they know that the markets are going to move big on comments that come out of the White House, even though nothing actually happens, right? Just somebody saying something, not actually doing anything, but just a post on Truth Social can cause massive swing in the stock markets, in the currency markets, in the crypto market. I'm sure there are people in the Trump administration that are trading off of it. How could they not be, given the size of the moves and the fact that, no actual news. I don't even know if it's insider trading because there's nothing actually happening. These are just comments that really don't mean anything. And in fact, I think the comments are specifically designed to impact the market. I think Donald Trump's comment about Powell was, oh my God, the market's getting killed. I need to turn it around. So let me reassure the markets that, there's still Fed independence, because that was what people were worried about, that, this means that we're not going to have an independent Fed. We're going to have a Fed controlled by the White House, and that's going to be bad, as if, it hasn't been bad all along. But I agree that the more you politicize the central bank, the worse it is, because all the political pressure is for easy money. That's why it's ridiculous for Donald Trump to be accusing Powell of being political, in that Powell is not cutting rate, because that's political. So the fact that he's holding tight is more of an independent move, because the political pressure is to cut. Now, he should actually be raising rate. And I think the fact that he's not raising rate is because of political pressure.
A few days ago, I tweeted, gold could hit $10,000 and Barrick would still be trading like gold was $1,200. Now, obviously, that's an exaggeration, but not by much, because these stocks have completely decoupled from the fundamentals. And the reason? Nobody believes the price of gold is real. They think it's a fluke, a spike, a trade, not a structural, generational monetary shift. That's the problem. Wall Street still treats gold like a commodity, not a currency, like it's copper, like it's wheat, like it's just another line item in a Bloomberg terminal. But gold is money. It has no counterparty risk. It doesn't default. It doesn't dilute. It doesn't get printed into oblivion by some clown in a central bank chair with a PhD in economic fantasy. Gold is the only asset that isn't someone else's liability. That's why central banks are buying it. That's why Russia, China, Turkey, India, Kazakhstan, you name it, are stacking record amounts of it. Not ETFs, not futures. Physical, vaulted, allocated, settled. And let me tell you something else. They're not trading it. They're not flipping it. They're not hedging it. They're accumulating it for the same reason you'd build a foundation under a house. Because they know what's coming. The dollar is being dethroned. Let me repeat that because it's critical. The US dollar, the backbone of global trade and reserves for nearly 80 years, is being slowly, strategically, and systematically replaced. Not because countries hate America, not because of some conspiracy, but because it no longer makes financial sense to store value in a currency backed by nothing and issued by a nation drowning in unsustainable debt. We're running $2 trillion deficits annually, with no recession. Wait until unemployment rises and tax receipts collapse. Wait until the next bailout or war. Who's going to fund that? Japan? China? The Fed? Please, the Fed is the market now. They're buying everything, monetizing the debt like Weimar Germany with better marketing. And what does Wall Street do in response? Buys more Nvidia. The mispricing here is beyond belief. Let me break it down. When you buy a gold miner right now, say Newmont or Agnico Eagle, you're buying into a business model where input costs are mostly fixed and revenue is tied to gold. If gold goes from $1,800 to $3,300, that's not a 90% increase in revenue. That's a multiplication of earnings. Because every dollar above the all-in sustaining cost, which by the way is still in the $1,100 to $1,300 range for most majors, drops almost entirely to the bottom line. This is operational leverage on steroids. Newmont, with a 127% profit jump last quarter, is just the start. And if you think that's impressive, wait until you see the juniors, companies with lower overhead, higher grades, and greater torque to the gold price. They're going to explode once capital comes back to the sector. Right now, money is still chasing fake growth. It's in AI. It's in SPACs. It's in garbage meme tokens. But smart money, sovereign wealth, private family offices, billionaire funds, is starting to rotate, quietly, because they don't want to move the market. Yet. There's another layer here most people miss. We are entering a world of capital controls, financial surveillance, and weaponized currency policy. Just ask Russia, or Iran, or even Canada for that matter. When push comes to shove, your bank account is a privilege, not a right. Gold? That's sovereignty in your hand. Now let's go back to the miners. Wall Street analysts still have $1,800 or $2,000 gold baked into their models. That's what they're basing their earnings multiples on. That's why they say, oh, this stock is expensive. Really? Based on what? Fantasy land pricing? What are you even doing? This is like valuing Amazon in 2010 based on bookstore revenue. The whole thesis has changed. The whole world has changed. Gold isn't just going up, it's reclaiming its role as the cornerstone of value. And these companies, mining real money, are the most mispriced assets in the entire global market. And yet, the average portfolio has zero exposure. None. You know who gets this? Not BlackRock, not JP Morgan, but some guy in rural Australia stacking coins in his basement. He understands better than half the clowns managing pension funds. And you know what? He's going to be proven right. Again. I'll tell you a funny story. Someone sent me a screenshot of a Bloomberg article. Headline said something like, "Gold rally might be overdone as investors cool on safe haven demand." That article dropped the same day China added another 15 tons to their reserves. That's the disconnect. That's the irony. When the West sells paper gold, the East buys physical. When Wall Street freaks out over a $60 drop, the Shanghai Gold Exchange sees record deliveries. This isn't a dip, it's a discount. A transfer of wealth from the impatient to the prepared. Now let me tell you what happens next. We're going to see another leg higher in gold, 3,600, 4,000, maybe higher, fueled not by fear, but by recognition. When institutional capital finally wakes up to the math, the leverage, the valuation absurdity, they'll pile in, and they won't buy coins. They'll buy miners, because that's the fastest way to gain exposure at scale. At that point, we get the re-rating. Not 10%, not 20%, but 300%, 500%. We've seen it before, in 2001 to 2006, in 2010, and we'll see it again. The setup is even better now. Supply chains are constrained. Exploration has been gutted. Capex has been slashed. There are no major new discoveries. The majors are desperate to replenish reserves. And the only way to do that is by acquiring juniors who are trading at fire sale prices. So you get M&A, you get consolidation, and you get lift. This is how a gold bull market matures. First the metal, then the miners, then the mania. But by the time the mania hits, the gains are gone. You'll be watching it on CNBC, while some guy in a Ferrari tells you about his 20-bagger. Don't be that guy who waited for a pullback and ended up with a postcard from the moon. Look, I don't have a crystal ball, but I've studied history. I've lived through multiple gold cycles. I've watched the same mistakes repeat again and again. And I'm telling you right now, we are on the verge of a revaluation, of gold, of value, of truth. The fiat charade is cracking, and when it breaks, it will be sudden. Gold doesn't need to prove itself anymore. It's already done that. What needs to change is perception, and perception changes slowly, then all at once. So get ahead of it. Before the re-rating, before the headlines, before Wall Street wakes up and does what it always does, pile in too late, too fast and too high. Let them chase, let them pay premiums. You get in before the stampede, because the stampede is coming. Thanks for sticking with me. And remember, this isn't about being bullish on gold. It's about being realistic about the world, about debt, about currency, about risk. It's about seeing what others won't until it's too late. Stay sharp, stay contrarian, stay sane, and for God's sake, stay out of tech stocks.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.